Federal Reserve decided to cut interest rates by 50 basis points. What is that going to mean to the market overall? I'm Tom Preston, Chief Market Strategist at tastylive. And in this week's Cherry Pick, we're going to talk about how that rate cut might hit the market and how it's calculated. So Mike Reckentine and Nick Batista put out some really interesting information about what happens in the market. What they did was they went to the CME FedWatch tool and analyzed the Fed funds futures price to see what the probability of rate cut would be. And the day before, the Federal Reserve cut them on Wednesday, September 18th. And prior to that, you could actually see what the probability was of a rate cut and how big. So in other words, 25 basis points, 50 basis points. And just so everybody is familiar with the terminology, what the Fed funds are, it is the interest rate that banks borrow and lend from each other overnight. And they do that to meet their capital requirements as dictated by the Federal Reserve. And so what the Fed funds rate is, it's a range. Typically, let's say 5% to 5.25%, something like that. That's an annualized number, but that's what the Fed funds are. You and I really don't use Fed funds rates very much, if at all, because we're not banks and we don't have billions of dollars of capital to manage. That said, there are Fed funds futures, and those futures prices can give you a probability of a rate cut or a rate hike in this case. And because everybody was talking about rate cuts, that's where the bias was. So what the Fed funds probabilities are based on, it is a time-weighted average of the Fed funds futures price. That's it in a nutshell. It's a little more complicated than that. But it looks at the Fed funds futures prices for expirations before and after the FOMC meetings and sees what the prices are and distills down a probability from those prices. So it's based on live market data and is a fairly transparent calculation. So what was happening is prior to the 18th, the probability of a 50 basis point rate cut, and a basis point is 0.01%. 1% is 100 basis points. A 50 basis point rate cut, there was about a 59% probability of that. 25 basis point would have been about 41%. So if you were paying attention to the market and watching this tool, for example, yesterday's rate cut wasn't a big surprise. 50 basis points was the likely event. What does that actually mean to the market? The guys put together, going back to 25 years ago, some information about the date and the number of basis points that the FOMC changed the Fed funds rate by. 25%, 25 basis points, 75 basis points, down 100 basis points, et cetera, et cetera. And then what the S&Ps did afterwards, whether it's 1 day, 2 weeks, or 6 months. And what you see is generally rate hikes. In other words, increasing by 25 basis points, 75 basis points. There was a bias upward over 6 months. The shorter term was pretty random. Sometimes it was up, sometimes it was down. A little bit of a bias towards the upside. Let's look at when there were rate cuts. Again, they were a little bit lower, sometimes dramatically lower, and this one, they were dramatically higher. It's kind of random, in my opinion. Looking at this data, it's hard to come up with any definitive plan to say if interest rates are cut, the S&Ps will do this or won't do that. That's a hard way to trade, I think. When you go down and, the rationale, as the guys pointed out here, when the Fed cuts interest rates, the S&P tends to react positively at first because it might be cheaper to borrow money, therefore, companies can invest, and cash that's earning a higher interest rate is now not earning a high interest rate. It flows into equities. That's the broader explanation. And the same is true of a rate hike, right? But the excitement doesn't always last. What happens after a rate cut, they do the median and the average, and they're basically the same kind of information. That when there's a rate cut, it's a short-term increase. 1 day, 3 days later, As you go out longer term, it's really kind of hard to see what might happen. And 6 months later, the market was down 7.5% when the rate increased. And they're just distilling this information down for you. 6 months later, for a rate increase, it's up 4.2%. So one clear benefit for everyday people is that mortgage rates tend to fall when interest rates are cut. Let's talk a little bit about that. That is a longer term thing. Mortgage rates traditionally are based off of or look at the 10-year note futures, okay, or the 10-year treasury notes, right? Why? Because, and this is traditional, it's changed a little bit over time, but basically it's that most people, when they have a 30-year mortgage, they don't hold the house forever. They sell the house and pay off the mortgage with the sale, and they refinance, et cetera, et cetera. So the average maturity of a mortgage is around 10 years. And so what you would, the bankers would use 10-year treasury notes as a hedge, or as one way. There are a bunch of different ways to hedge a mortgage. And you can slice and dice mortgages, a bunch of different ways to hedge those components. But the 10-year note was what people were looking at. As we look at, let's take a look at what happened over the past couple of days. ZN are the 10-year futures, and those have actually fallen. And remember that bond prices and note prices move inverse to interest rates. When interest rates go down, bond prices go up. When interest rates go up, bond prices go down. The mirror image of that is true also. I'm seeing ZN dropping here. That means its yield is going up. But they just cut short-term rates. Yeah, short-term. Fed funds is overnight. That rate cut doesn't start percolating down the yield curve, or more probably the term structure, to longer-dated maturities, and it may not, okay? The term structure has its own, it can flatten out, it can steepen, it can do all sorts of things. So it's going to take time if those short-term rates ever make it down to the longer dated maturities, like the 10 years, and actually might take the mortgage rates down even further. Look at what's been happening to the 10-year over the past few months, though. Yeah, the 10-year note, ZN, has been rallying, and that's been pushing down its yield, and that is also true. Mortgages are about 100 basis points, about 1% lower than what they were last year. Last year they were about 7%, now they're about 6%. But still, that's over 2 times higher than what they were a few years ago. So a 6% mortgage is still housing is still expensive to buy. There's still, for example, in a bigger picture, their credit card debt is at a record high. Delinquencies on those credit cards are high. Delinquencies on car loans is high. So it's going to take a while for this rate cut to maybe make it to the consumer. What it does do is cut down what you're earning on your savings and maybe CDs. If you're a saver, if you have cash at the bank, you've been earning 4.5%, 5% on your CDs over the past couple of years, even higher sometimes. But now those CD rates are being cut. So what banks do, banks love to make money, and one of the ways they do is by giving you, the saver, a lower interest rate than what they're charging people for borrowing money, like a mortgage. So they'll keep those mortgages relatively high and cut the CD rates immediately. With this, and let's check just bonds for the sake of just looking at it. ZB, bonds are down too. So the 10-year and 30-year yields are higher. Okay, so I'm not sure how much this rate cut is actually going to affect the broader market. If big companies are borrowing money overnight, yeah, the Fed funds rates will affect that. But most of those companies that do that, that's not a major source of their revenue. I think there are other reasons why the S&P is basically trading at record highs. There's other reasons why you think that the S&Ps might continue to rally, right? That as big companies that are kind of immune to inflation and interest rate changes and things like that, they have such a huge customer following that people just love buying their iPhones or whatever they are. It just keeps the market pushed higher. The dollars, the investment dollars, now they're getting less on their earnings on short-term interest rate products, like whether it's CDs or T-bills. That money could just as well flow into equities at this point. So there's an incentive to say, or there's a reason to think that, the S&Ps might have an upward bias over the next few months. Does that have any reason to do with the economy? Not necessarily. Does that have anything to do with the interest rate cut? Marginally. Okay, so understand it in those terms, that the cut in the Fed funds rate, as big as it was, everybody expected it, or I should say traders expected it. So it wasn't really a surprise. It benefits banks. That's why bank stocks are up a little bit today. Goldman Sachs is up a lot, actually. Some of the, XLF, the ETF that tracks financials, is also up today. So it benefits bank stocks. Does it benefit consumers? Probably not. Okay, so that's why it's, great. Okay, the Fed cut interest rates for overnight borrowing and lending among banks. Big deal. How am I going to make money? Well, one of the things the guys are looking at, a couple of trade ideas. One was the XSP double calendar. That already expired, the XSP. Basically, that would have made some money. What they're also looking at is an iron condor in the Qs. So the NASDAQ has been the most volatile of the major indexes. It's not as volatile as IWM, but from the big cap stocks. Nearly $100 range throughout 2024. It's right back in the middle of the most recent trend. If you think we might chop around a bit, the iron condor is a defined risk rate a bit to trade it. So what are they doing? They're going out to about 30 days and they're putting on a 10 point, the 440, 450, 500, 510. Let's take a look at that. And they're getting a 255 credit. Let's take a look at Qs. We're rallying the Qs today, but over the past couple of months, it really has been moving back and forth. Let's go into the options, and in this October expiration, it was, let me just make sure I'm looking at the right one, the 40, 50, 500, 510. So selling the 450 puts, buying the 440 puts, selling the 500 call, buying the 510 call, 279 credit, not quite a third of the width of the strikes, which is what a target is. Has a max loss 721, max potential profit 279. Is a 78% probability of making half its max profit of 279, so that's about $140, not bad. Generates $6.23 of theta. Let's tighten this up a bit. Let's move this put spread up and make it 5 points, and this call spread down, call down a little bit. $1.83. All right. I wonder if we can move this. Yeah, let's stick with this for now. Let's look at this one. So with the Qs rallying up today, and the IV rank 24%, that's pretty good. Q volatility at 22% isn't screaming high, but let's take a look at this trade here. So the long 460, short the 465 puts, short the 505 call, long the 510 call. What that does is a third of 5 is about 1.6, 1.65. $1.60 is about a third, so that's kind of within that 1/3 credit target. Maximum loss is $339. Max profit is $162. So this is an interesting possibility if you have a smaller size account. It uses up only about $340 of capital. Not bad. Has a 72% probability of making half of that, is about $80 in the next 29 days, and generates about $3.10 of theta per day. So this is a trade. If you think that the Qs are going to stay in range, an iron condor is a way to trade it. This is how, focusing on some actual trading products like the Qs or even the SPY or even, bonds is a much more interesting discussion than arguing about how an interest rate cut is going to or not going to affect the economy or the market. So if you want to get these cherry picks delivered to your inbox every week and my cherry bombs delivered daily, click on the link below.